All right, let's get this party started. All right, make sure I'm doing this right. Hey, everybody, this is Lance Grove from Grove 1031. Thank you guys for joining us. This is actually we try to keep these very quickly because we know it's in the middle of the day. So try to get this done under 30 minutes, sometimes under 20. But for those who don't know, we run a 1031 exchange accommodating company, and this is kind of boilerplate information for people to understand, all right, how do these things work? Because they're vital. So we're going to go over just basic information, but a little housekeeping. You guys feel free to ask any questions you want, in the little chat area. If I can, I'll answer it as we're speaking. If not, I make sure I try to sit down, give everybody a call after the webinar and answer any questions then on. But just for you guys to understand, this is just basically a refresher. So you guys understand what is a 1031, how does it work? Hopefully you guys can understand, how to talk to your clients about it. But if not, now you guys have me. You guys can give us a call anytime. So anyway, again, my name is Lance Grove. I work with Grove 1031, and we conduct 1031 exchanges. So for anybody who needs to know what those are, and we are going to go into it. And what I always like to do is start off with the verbatim definition of what a 1031 exchange is, because oftentimes people, they do these transactions and then it's typically at closing. If they have a good escrow officer, a good closing agent, they will say, hey, this seems like it's a 1031 exchange. You don't want to, oh, I don't know, protect yourself. And then they call people like us, or people Google and they find random things. So before you guys Google, this right here is the verbatim definition of what a 1031 exchange is. And it is a section of the U.S. Internal Revenue Code that allows investors to defer capital gains on an exchange of like-kind properties held for business or investment purposes. And if people struggle understanding that fancy way of wording things, I always like to lead with a wonderful example. Okay, so right here, pretend that you purchase a property for about 100,000, and then a couple years down the line, you want to sell it for about $1 million. Now, everybody's typically excited about this right here, which is the $900,000 profit. But what they don't realize is actually one of the biggest taxable event of a taxpayer's life, because between state tax, federal tax, what's called your depreciation recapture tax, that's going to be a blended average of roughly 30 to 33%. So that example that we use where you bought a property at 100,000 10 years ago, time elapsed, now it's worth 1 million. You want to see that $900,000 profit when you sell, but nobody's talking about that 320,000 tax that they're going to get hit with. So 1031 exchange allows you to keep that money in your pocket and keep it moving. And by the way, I'm going to send you guys a 1031 exchange basic sheets that has all this information. I just like to put it out there so you guys can follow along. But there are 4 basic core rules to a 1031 exchange. The first rule is, does a property qualify? The second rule is the process of deferring your taxes. The third rule is your 45-day date, which is probably the most significant rule. And the last rule is your 180-day date. So we're going to go into these 4 stages. Feel free, any area that I'm in, feel free to ask questions. I am more than happy to answer them. Now, simple rule you just got to ask is, does a property qualify? And the definition is here. Is the property qualify if it is held for business or investment purposes? And the key here is to focus on what is the intent, because you can purchase people sometimes get commercial convoluted. They think commercial is if it's zoned in commercial, if it's an office space. Commercial is kind of the utility of a property. So you can purchase a home in a residential area. If you live in there, it does not qualify. That is your home. You can purchase that same home in a residential area, residential home. You don't live in there. You let someone else live in there. They pay you money for it. That then qualifies because the real estate is being utilized for investment purposes. And then when you're doing a 1031 exchange, you're basically exchanging into like-kind property, which is property with the same intent, the same utility. really simple and plain is if you sell a property that you use for business or investment, then you have to go into a new property that you use for business or investment purposes. Really simple and plain because you can go from, the residential unit that you rented out to a friend. You can sell that and you can reinvest into an office space, which is very clearly commercial, but you can also sell that office space and go into a plot of raw land as long as you're using it for investment purposes and so on and so on. Basically, just as long as it's not your primary residence. So that's the first thing you do whenever you're thinking about a 1031 exchange. Quick side note, if it is a residential, the code for that is called a 121, but most people know it as a homeowner's exemption. So if it's your primary residence, it's a 121 homeowner's exemption. And if it's a 1031, if it's an investment property, then it's a 1031 exchange. Okay. So that's the first rule. Does the property qualify? Yes, if it is held for business or investment purposes. And the other big rule is when these people are selling property, and I encourage everybody, especially real estate agents, if your clients are selling property, you want them to talk to a CPA before they sell the property because it really is probably the largest taxable consequence that they're going to suffer. And the CPA is going to basically do that kind of example I did there. They'll take how much did they buy it for, how much did they sell it for, that little area is called a profit, and that's what they get taxed on. And that's when they're going to need a 1031 exchange. So whenever you're doing these things, have your client speak to a CPA. And should they speak to a CPA and give them that terrifying tax bill, as long as you have a 1031 exchange accommodator, then you can alleviate their fear. So the client, they sell the property, they go to a CPA, they're like, oh my God, I have all these taxes. And then you find your accommodator. And when we're conducting this in 1031 exchange, in order to defer 100% of the taxes, they basically have to do two simple things. One, they have to reinvest 100% of the funds into a new property. And two, that property must be of equal or greater in value. Simple and plain. When they sell the property, they have to reinvest all of the funds into a new property at equal or greater in value. And this sometimes causes some confusion. People will say, well, what if this? What if this? Here's a couple examples. You'll say you sell this property at $500,000. Great, you're selling property at $500,000. At closing, you are going to probably pay off maybe a mortgage of $200,000. So all you have is $300,000 left in cash. Great. The rule still stands. They still have to purchase a new property at $500,000 or greater to defer 100% of their capital gains. It doesn't take into account that you have to pay the mortgage. If you sold at $500,000, you have to buy at $500,000. Simple and plain. So keep that in mind. It looks like we have a question here. Yes, recording is provided. It's a good question, I guess. Yeah, recording is provided. So when they're selling the property, you have to reinvest into a new property at equal or greater in value. And the focus on that is called your net sales price, because when they sell the property at $500,000, they get to basically subtract all of their closing costs, all the fees that incur at closing, title fees, agent fees, those things. But I want you guys to hone in on this, because if they don't, purchase a new property equal or greater in value, it doesn't disqualify them. It's just that every dollar they fall short, they will pay taxes on. So if they sold at $500,000 and they have to purchase at $500,000, but let's say they only purchase at $450,000, great. They're going to get taxed on $50,000 that they fall short, and the $450,000 will be completely tax deferred. So that's like a main thing that pops up. Is this another one? Hold on here. It's another question, or just answered? We're good there. Got it. Anyway, so purchase equal or greater in value. And you have to, if you fall short, you're not disqualified. That just means you're going to be taxed on every dollar you fall short. So please keep that in mind, because sometimes people are shocked. I got a client right now. He just sold a property about $1 million, paid off his loan. He has about $400,000 left. And he's just like, I just want another $400,000 property. I'm like, you're going to pay your taxes, like a lot of them. So find a new property, get a new loan. It is what it is. So they do have to meet that threshold to get back up there. Here we go. My favorite rule. This is called your 45-day rule. This is actually 180-day rule. This is basically your timeline to conduct this exchange. And the timelines are probably the most singular reason exchanges fail. And you think about it, from the time the transaction closes, contract closes, escrow closes, the individual's name is taken off the title. The moment that happens, that's when the taxes are pretty much triggered. And from that point, they have 45 days to identify a replacement property. And then they have 180 days to actually acquire that replacement property. So they're selling their piece of property here, closes escrow, those two gun goes off. And I like this little timeline we've created. The first timeline they have to worry about is right here, the ID period. And they have to submit this in writing to basically your exchange accommodator. They can't do it to anybody else, not the escrow, not their friend, not the lender or the agent. Like these things have to run through us. So from the close of escrow, the client's going to have 45 days to identify their replacement property. And that identification can be in two ways. The first one is called your 45-day, not 45-day, three property rule right here. They can identify basically three properties, and it does not matter how expensive these properties are. So the example we're going to use is sell a property for 1 million. You identify one property for 2 million, 3 million, 8 million. You have three options, and it can be as expensive as you want. Doesn't matter, just as long as you get over that threshold of what you sold for. So if you sold for 1 million, you're going to want to identify properties for 1 million or greater. And if you sold for 1 million and you want to identify two $500,000 properties, that works as well. Also, fun added fact, you can identify anywhere in the US or US territory. A 1031 exchange is a federal guideline. It applies to all US states and all US territories. So these things are pretty versatile. We have a lot of clients selling out of California and New York and going into Texas, Atlanta. They're coming into North Carolina. So 1031 exchange is a federal guideline. It applies pretty much all over the US, all the US territories, Guam, Puerto Rico. So when you sell, you can use the three property rule. You have three options, and I always stress, use all three. And now if that doesn't work, you can use what's called the 200% rule. And under that rule, you can identify an unlimited number of properties, provided that the aggregated sum does not exceed 200% of your initial sales price. So in the example we use with the 1 million, we sold for 1 million. We can go and identify as many properties as we want, provided that the total sum doesn't exceed 2 million. Because 2 million is 200% of 1 million. Simple and plain. Three property rule, you're limited in your options. You can only do three, but you're not limited in your valuation. Go nuts. 200% rule, you can do as many as you want, but you are limited in your valuation. So those are the two ways you can identify property. And it's really simple. Just close escrow, you find a property, get an address, get a price, sign it, hand it to your accommodator. That's our company. Done and done. You don't have to be under contract in escrow. It is identifying. Just find an address, find a value, and you're done. Here are some of the common questions we get, because you guys are really quiet. Either you guys are brilliant or something else. But anyway, people always ask, well, what if I don't reinvest all of my cash? Like you said, you have to purchase at equal or greater in value. You sell a property at roughly $1 million, and now you're only, reinvesting 900,000. Great, 900,000 will be completely tax deferred, but the 100,000 you fall short, you will pay taxes on. Or they ask, well, do I have to replace my debt? Same example we use. You sell a property at 100,000, but you have to pay off a mortgage of 500,000. Yes, you got to make up that money to get back up to that 1 million on your purchase. Looks like we get another question here. What's the deal with the 180 day again? No problem. I'll go back for that. There we go. So when you're doing a 1031 exchange, there's two timelines you have to focus on. You have one, your 45-day rule. You have 45 days to identify your replacement property. And two, you have your 180-day rule, which is basically you have 180 days to conduct this entire exchange. From the point of sale, escrow closing, two timelines go off. 45-day, 180-day. First timeline, find a property, identify it. Second timeline, get your name on title to that property, own it. Okay, that's why that one's much longer, because it is a whole process. You have to find a property, and then you have to make your offer, put your deposit, go down there, do your inspections, make sure everything they said is what. Then you got to get your financing, then you have to provide it, and then you close, you got to record it, put your name on title, done. That sometimes can take a bit. Well, it always takes a bit. But those are the two timelines you just have to worry about with a 1031 exchange. A common question we get is, can I purchase multiple properties? And yes, you can purchase multiple properties. So if you sell one property for $1 million, then you can go and buy $100,000 properties. Doesn't matter with the structure. All they care about is that you own as much real estate as you sold. So you can buy multiple properties. You can purchase properties out of state. You can purchase different asset classes. You sold two residential homes. Now you're buying a parking lot and an office space. It works out just great. Got another question here. Can I purchase tax deed auctions for a client? It's a good question. A tax deed auction? I'm not too sure exactly what that is, but we have done a few transactions where, auction properties have been involved, and it was really difficult because one, the client can never touch the funds. That's what we're here for. They can never be in constructive receipt of the funds. And from my knowledge, I remember they were asking for a check because once the property sells, all the client's funds go into their exchange account, which we held, and then we wire it to their replacement property. So they were asking for a check from like a client, and I was like, yeah, that's not going to happen. Give us an account number. We will wire it in there. And the other thing, a big rule with a 1031 exchange is the client's name on the sale property has to be the name on the replacement property. So at closing, if we wired those funds, we needed to ensure that, hey, once those funds are wired, then that means that the client's name goes on to the property. So purchasing tax deeds, I'm not too familiar with that, but we've done, a deed in an auction, a transaction in an auction. It was really difficult because they basically had to take all these different routes that they don't take. But yeah, the rules that govern that is it's doable if, the client's name immediately goes on title. It's doable if funds can be directly sent to, the auction party's closing agent, escrow company, whatever it takes to keep the funds secure in transition. Like they sell the property, funds go to their exchange account. From the exchange account, it goes directly to a replacement property, whether that be an auction or whatever it is. But yeah, the client's name has to go directly onto that thing. Right here. Quick thing about our company is we're fully insured and bonded. We're headquartered in San Diego, but now we have a wonderful office here in Atlanta. We've recently moved here for the past month now. We're part of the FEA, which is the Federal Exchange of Accommodators, kind of like our governing body. And yeah, our team has been through painstaking background checks, which none of them enjoyed. This is general information about us. You can always email us at info@growth1031. Our number is very simple, 619-991-1031. But to everybody on here, like I said, I try to make this quick. Look at us, still under 30. Please always make sure you keep track of this stuff because it happens all the time. If you are selling any kind of investment property, chances are you probably don't think about the fact that on March 15th for the following year, your CPA is probably going to hand you a big fat tax bill because you did not have the foresight to speak to your CPA before you sell this transaction. So when you sell and the following year you get hit with this pretty burdensome news, it's pretty tough. So it's as simple as speak to your CPA prior. If you're selling investment property, the moment you accept an offer, give us a call. It's as simple as that. We honestly operate more as an educational resource. We hand out more information than we actually do transactions. We're on the phone talking to clients, talking to investors, talking to agents, clients, just, hey, this is how this works. This is how this works. We're not charging a fee for information. So anytime you guys have questions, give us a call because this is a pretty significant thing. When you sell these assets, it's a big taxable consequence that gets triggered and People learn about it a bit too late. So you want to actually contact companies like ours before you sell these assets. And to real estate agents or investors, it's a big thing when you're going to find a new client and new agent and you're like, hey, let me sell your property. I'm going to charge you 3 to 6%, whatever it is. Now you can say, hey, I'm going to charge you 3 to 6%. And by the way, I'm going to save you 33% on all of your profit. So it's a pretty big tool to help agents, find new clients and incentivize them because especially in this day and age, people are trying to protect their capital, like specifically. And with a 1031 exchange, if you help them do that, the requirement is you probably have to help them find a new property because when they sell, the only way they can defer their taxes is by going into a new investment. So please feel free, give us a call. Our number is simple, 619-991-1031.